If you're like most investors and you're concerned about the recent stock market volatility, then I'm going to give you 6 suggestions as far as tactical moves that you can make to take advantage of these recent stock market declines. Welcome back. This is episode 249. It's been an interesting week for the stock market, to say the least. And I record these episodes about 5 to 7 days before they're released. I'm recording this on April 9th. And over the previous week, the stock market is down significantly due to concerns over the recent tariffs that President Trump put into place. And for 2025, the S&P 500 index is down about 15% as of September 8th. And the NASDAQ composite was down about 19% also through September 8th. So significant declines, and most of that decline really coming in the last week. But I'm recording this after the stock market closed on April 9th, and we have had the biggest rally in the market today since 2008. I'm not exactly sure when in 2008. I just saw that earlier. The S&P 500 gained 9.5% today, and the NASDAQ composite gained a little over 12%. That is an incredible move to see. It was also an incredible decline to see in the previous week. Multiple days with 4 to 5% declines in those markets. Now, now why did the market go up so much? Well, it was because President Trump announced that he is putting a 90-day pause on tariffs, the reciprocal tariffs, which is really what sent the market haywire over the previous week. And however, he's keeping the tariffs on China. He had recently announced that he's going to increase those. I think he might have even announced he's increasing them further. So we'll have to wait and see. Obviously, any news about tariffs is going to move the markets up or down. So we're probably not done with this saga, the trade tariff saga. However, I do want to give you 6 tactical moves that you can make anytime there's a down market, and in particular with this down stock market. And whether you take advantage of some of these now, or maybe there'll even be another opportunity because, as I said, we're not done with this tariff saga, and we do have 90 days from now where some of these things could be going back into place. Additionally, I posted a video earlier this week on my YouTube channel where I was giving some perspective on the recent stock market volatility, so you can check that out as well. If you know if you're already watching this online, you click on videos. If you're listening, you could head over to retirewithryan.com and click on videos. So I just want to thank again all my loyal listeners. I appreciate you helping me continue to grow the podcast. I'm getting close to episode 250. That's next week. And as I've been mentioning, I know that I can do more. I get a lot of great feedback from people that they find this content very helpful. So to help me reach more people, I need more reviews. And there's 2 ways you can leave me a review. One way is you can do it on the Apple Podcast app if you have an iPhone. The other is on Spotify. So if you have Apple Podcast app, pull out your app, search my show by typing in Retire with Ryan. You'll then scroll down and you'll go to the bottom where you see ratings and click on Tap to Rate and leave me a review. If you're listening on Spotify, it's even easier. Again, you search my show on the Spotify app by searching Retire with Ryan and scroll to the top and click on rating. It's that easy, and I greatly appreciate it. If you have left a review, drop me a message and let me know. You can do that by going over to retirewithryan.com and clicking on Ask a Question. So let's get into these 6 moves that you could make when you have market declines like we've had recently. So the first is pretty obvious, and that is buy the dip. Meaning take advantage of the decline. Now, obviously, not everyone could do that. If you're fully invested, it's kind of hard to take advantage of the decline. But let's say you're not fully invested. You have some money that you have that's not invested, whether it be in your bank account, in money market, in a CD, a bond, more conservative money. You could take advantage of the dip and you could buy into the decline. And obviously, it's impossible to know when the bottom is, but if things are down significant, and when I say significant, 10% decline or more is significant. We were approaching 20% declines until today. That's significant. This is a buying opportunity. you're never going to know when the bottom of the market is. You only know after the fact. So by buying in when things are down, you're definitely getting an opportunity, and it's uncertain when you'll realize that opportunity, but most likely in the future you'll see the benefit of buying in. And it's hard to do this because things are scary when the market's selling off, but it is the opportunity, right? I think of Warren Buffett said, "Be greedy when other people are fearful." So that's something you could do. Now, you could do this a couple different ways. You could just do this with a taxable investment account, but you could also get started on your contributions for Roth IRAs or HSAs for 2025. 2025, has begun, and we've finished the first quarter of the year, but you could fully fund your Roth IRA for 2025 or your IRA or your HSA if you put that in through non-payroll contributions. So by doing that now, you're taking advantage of the decline, getting the money in faster, and then hopefully the money will grow for you over time, from where you're buying in today. So that's strategy number one. One thing I want to mention about that too is that if also you're saving into 529 accounts for your children, maybe you could do that. You could get that money in now rather than waiting till the end of the year and take advantage of that. So strategy number two is to consider rebalancing your portfolio. I've talked about this before, but everybody should have a target asset allocation. What do I mean by that? That is the amount of money, just to simplify it, that you're keeping invested in stocks versus bonds. So let's say you're someone who's retired and your target allocation is 60% stocks and 40% bonds. Then if you looked at your account recently, you would have seen that if that was your allocation at the beginning of the year, you were getting closer to 50% stocks, 50% bonds. So if we had stayed down, that would be a good time to rebalance, meaning you're going to actually buy more stocks by getting your allocation back up to 60% stocks, 40% bonds. So if you don't do this, then you're not really taking advantage of this buying opportunity. This is a way to do it without having to put a lot of thought into it, because when you start thinking about your money, deciding whether to buy or not buy, you're more likely to not buy, because it's very hard to buy when you're seeing consistent selling, consistent declines. But if you have a process in place, that you have a mechanism where you look at your asset allocation, it's out of line by more than 5%, time for me to buy. The opposite could be happen when things go up. If all of a sudden you found yourself 70% invested in stocks instead of 60, you actually should be selling some of your stocks, taking profits and putting that into bonds. So you can either do this yourself by just having a target allocation and then checking in on it every so often. If you work with a financial advisor, this is part of the service they should be providing too. Or if you're in a 401k plan, you can possibly automate this. So you can automate your allocation, your target, and then the system will automatically do it. But you should definitely have a target asset allocation and a rebalancing strategy. So if you don't, make sure that you put one in place. Strategy number three is to automate your investments. You're probably already doing this. If you're saving money in a 401k, you're doing it through payroll contributions, you're automating it. But what if you're not automating it? What if you do put your Roth IRA in at the end of the year, or your 529 contribution in at the end of the year, or your HSA contribution in at the end of the year? Think about automating that. If you set it up so that you put a certain amount in every month, that way you'll take advantage of what's known as dollar cost averaging. Some months you'll be getting lower prices, some months you'll be getting higher prices, but you'll be taking advantage of that, and then you can kind of not have to worry about the volatility of the market and looking for buying opportunities. You could just dollar cost average and get an average cost over time. Strategy number four is to sell your underperforming investments. So if you look at your investments and you're somebody who likes to own individual stocks, or you own a lot of mutual funds, anytime you have individual stocks or mutual funds that are underperforming the market, underperforming their benchmark, it could be a good time to get rid of them when they go down significantly in value. It generally tends to show a poor investment if we start to see a lot of market sell-off. Some of the worst investments will sell off more and go down even more. Now, I see all the time when taking on new clients and we look at their existing portfolios and they've been picking their own individual stocks, they have a lot of losers, meaning a lot of investments that have lost a lot of money. Some of them down 50, 70%, and they never sold. That should not be the case. I mean, if you see an investment go down 30, 40%, and the overall market's not down that much, that's usually an indication that's a poor investment and time to get rid of it. You could even cut your losses sooner than that, but sometimes if you cut your losses too soon, you can miss out on future appreciation. But if you have a lot of investments that are down much more than the market, and you're looking to simplify your life, you can think about getting rid of those investments, either buying another investment that you think is better, or you can just clean it up by getting more into index funds and simplify your investing strategy and use something like an S&P 500 index fund or a total stock market index fund. And that will just make your life a lot easier, and probably over time will also improve your performance. Strategy number 5 would be to take advantage of these tax losses inside of your taxable investment accounts. We're talking about taxable investment accounts. You can't take tax losses in retirement accounts. So if you have a taxable brokerage account, you have investments in there that are currently worth less than you paid for them, then you could sell those investments and take a loss on them. And you can write up to $3,000 of that loss off on your taxes for the 2025 tax year, or you can carry forward any loss above that and use that to write off the losses in future years or offset gains. So, for example, let's say you bought Apple stock recently and it's now at a big loss. Then you could sell Apple stock and buy another stock. Maybe you decide to buy NVIDIA. And if you wanted to buy the Apple stock back, you have to wait 30 days to be able to capitalize on the loss. If you buy it back within 30 days, you then void out the loss. So with individual stocks, you really have to be out of that stock for the 30 days. Now you could buy another stock, and if you could also buy a mutual fund or an ETF. If you buy an ETF, you can buy that immediately, and that's a way that you can stay invested in the market. And then you could also sell that and then buy the individual stock back at a certain point. But with mutual funds, there is a little bit more you have to be aware of, because you can't just sell one fund and buy any fund and be able to take the loss. The fund you're selling has to be substantially different. So let's say, for example, that you were buying the American Funds Growth Fund, or you own the American Funds Growth Fund of America. You could sell that stock or sell that mutual fund, take a loss, and you could buy something like the S&P 500 index fund, because it's a different fund. It might invest in some similar stuff, but it's different enough. However, if you currently own the Vanguard S&P 500 index fund, VOO, and you want to sell that and buy State Street's S&P 500 index fund, SPLG, those investments are too similar. That would not be a loss. That would be a wash. So just be aware of that. And this could be an opportunity to not only take some tax losses, but also to simplify the management strategy of your portfolio. Now, tip number 6 along that same vein is that you could reposition your taxable investment accounts into investments that are more tax efficient. Well, what does that mean? That means that mutual funds are not a very tax efficient investment. Not to pick on mutual funds a little bit. This is what's considered an open-ended mutual fund. So mutual funds are pooled investments, which means that whatever goes on inside that mutual fund, they have to report out to all the shareholders in that fund. So say, for example, you bought a mutual fund at the beginning of the year for $15 a share, and that fund didn't gain any value. At the end of the year, you have $15 a share. You could receive a capital gain distribution from that fund, let's say of $2 a share, and you have to pay tax now on that $2 a share in your fund, but you didn't actually gain any money in the fund. That's how mutual funds work. Now, how does that happen? Because let's say inside the fund, they were selling investments that they bought a while ago. Maybe they bought Apple, they bought Netflix, Tesla, something years ago that they made money on, and they sell it in the fund. They have to report that out to their investors. So as far as your taxable money, non-retirement money, mutual funds are not very tax efficient, because many people that own mutual funds get capital gain distributions and then have to pay taxes on those every year. So what's a better option? Well, one is owning individual stocks. And if you don't want to do that, and I advocate that most people don't, then use something like an exchange-traded fund or an ETF. The way that these ETFs are structured, they very rarely have to pay out capital gains distributions to their investors. The fund can actually gain money, but you're only paying a capital gain on the fund when you choose to sell it. So in my example, you buy an ETF for $50 a share, and if you don't sell it and you hold it 10 years later and it goes to $100 a share, most likely throughout those 10 years, you never received the capital gain distribution that you had to pay tax on. But if that was a mutual fund, chances are, maybe not every year, but many of those years, you're going to get a 1099 that you have to report on your taxes and pay tax on. Now, it is reducing your basis, but it's not really helping you because it's not helping you defer your gains. So that's why ETFs are much better for your taxable investments. So if you have mutual funds that are at a loss right now, that you can sell for a loss or maybe without much of a gain, and you're planning to hold them for a long time, consider using the proceeds of that money and putting that instead into an ETF. There's many ETFs out there that, depending on what you're looking for, you can use. But that is an easy thing that many people can do, especially when the stock market is down. That means that maybe these mutual funds are down in value from where you paid for them, and you could sell them at a loss or not much of a gain, and you could reposition that into an ETF or individual stocks that would be much more tax efficient for you over the long term. So even when the stock market is falling, there are some things that you can do where you could take advantage of this sell-off and try to make the most of it. And as I mentioned earlier, if you haven't watched the video I did on some other things to consider anytime we get sell-offs, some perspective and some tips on how to really manage your emotions during that time, you could head over to retirewithryan.com and click on videos. And if you haven't left me a review on Apple Podcasts or Spotify, please do that. I would greatly appreciate it. And as always, if you have a listener question, feel free to propose it for a future episode by heading over to retirewithryan.com and clicking on Ask a Question. Have a great week, and I look forward to talking with you next Tuesday. Take care.